session. I'm Kurt Peavy. I'm one of the senior consultants for Arthur J. Gallagher, who is the advisor over the Selden 401k plan. And so today, primarily, we'll be discussing taking distributions from 401ks and mainly the loan option that is available to you. Now, when it comes to this topic, anybody you would listen to would have a slightly different version of what they're going to say. The main reason being there are certain aspects that are objective. Can you take a loan? Yes. How much can you take? Up to 50, one half of your account balance, not to exceed 50%. So up to $50,000. And then should I take a loan? Now that is going to be very subjective, and it's going to be a little bit different for every person who is a participant in the 401k plan. And there's a lot of different reasons for that. I'm going to go ahead and pull up a document that I have, and I'm going to turn off my video so I can pull up the document. Now, a lot of people, if you just read general news about 401k plans, a lot of people are going to tell you it's a bad idea to take a loan out of a 401k. You're missing out on earnings opportunities. You're out of the market, et cetera, et cetera. And I actually take a little bit of a different approach to that. We all live in the real world. Unless you have inherited a trust fund, you have bills, you have expenses. We all do. We have emergencies that pop up kind of out of the blue. But when you take money out of your 401k, if it is an emergency, and how you do it can have some pretty big impacts on what your retirement savings is going to look like 10, 15, 20, 30 years down the road. So I'm going to talk kind of at a high level over kind of some of the implications and possible benefits of taking a loan out of your 401k plan. I'm going to walk through this kind of, I think it's a 5-page slide from Fidelity, and you can actually access this directly on the Fidelity website if you log in under your account, but I will forward this out to the calendar invitation after this meeting so that everybody has a copy of this. So kind of the key takeaways. Explore all options for getting cash before tapping your 401k plan. I agree with that. The problem is that something along the lines of 70% of all Americans don't have $1,000 in emergency savings to kind of take money out if they need it. So when it comes to that, if there is a big financial emergency that might pop up, you're going to be somewhat limited to your options if you are, again, the average American who's not flush with a lot of cash just sitting around and waiting for emergencies to happen. Now, every employer's plan has different rules for 401k withdrawals and loans. Not all offer loans. Yours does. A 401k loan may be a better option than a traditional hardship withdrawal. I actually believe in most cases that could be much more beneficial to you than a hardship. In most cases, loans are an option only for active employees, and this is also true. And there are a couple of pros and cons about taking a loan, and if you leave employment, that we'll also talk about at the end. And then if you opt for the loan, take steps to keep your retirement savings on track so you don't set yourself back. Now, when it comes to this, as I mentioned before, I live in the real world. We all do, right? We all have bills. Many of us live paycheck to paycheck. The issue when it comes to taking out a loan from your 401k is that oftentimes whatever you're going to be paying yourself back, because you will pay yourself back between 1 to 5 years, you get to pick the timeline on when the loan is paid back and how often. And then the amount that you're paying back may, in many cases, limit your ability to continue to defer your own money into the plan. So you're basically doing 2 contributions instead of 1. You're paying back your loan, which is required. It's really not an option. As long as you are an active employee, Selden is legally obligated as the plan sponsor to withhold the amount of money that's on the amortization schedule for your loan. So again, if you take out, just say $5,000 over 5 years, you're going to have a much smaller payment than if you take $5,000 and you want to pay that back over 1 year. But you can kind of do the loan modeling on the Fidelity website if that is something you think is going to be of interest to you. And you can find out exactly how much you're going to be paying yourself back. You will pay yourself back with interest. Typically, it's going to be prime interest rates, prime +1. So that is the good news. Even though the money's coming out of your account, you're missing out on any appreciation of your money when the stock market's going up. And you're going to be paying, but you will be paying yourself back with interest. So those are kind of the key fundamentals of what a loan is going to look like. One of the things I'm going to quickly go to is the different impact, and one of the reasons why I believe in many cases, taking a loan out is more beneficial than taking a hardship. Now, a hardship is really there for an immediate financial need, whether you have damage to your house from a natural disaster, or maybe it's unexpected medical expenses. The issue, though, with a withdrawal is you do pay taxes on the withdrawal. So whatever you take out under this scenario, person has $38,000, they want to take out $15,000. So on the left, if you take out a loan, you're not paying any taxes, and regardless of your age, you're not going to pay any penalty to the IRS. So you have 38,000, you take out 15,000, you have $23,000 left in your account. And this is assuming somebody needs net $15,000 in hand. Same person, if they have the same account balance, $38,000, they need $15,000 to net that $15,000. Keep in mind you owe taxes on it, and also a 10% premature distribution penalty if you're under the age of 59 and a half. So under the same scenario, you need $15,000 in hand. You're going to have to take out approximately $20,000. That's to cover the $15,000 you need, plus a 10% penalty, plus any taxes, leaving you with $18,000. Now, when it comes to hardships, those cannot be paid back. So essentially, if you have a massive financial need, hardship is there available to you, but the money comes out permanently and you're subject to tax and penalty. You can't pay yourself back. Whereas with a loan, as is with a mortgage or a car loan or anything else, you are paying that loan back into your account and you're paying yourself back with interest. So those are really the two big differences between taking a loan out of your 401k versus a withdrawal. And as you can see, for most people, taking a loan is going to be much more beneficial and limit the long-term impact you're going to have on your overall balance in your 401k plan. Now, a couple things to consider. I will always say that regardless, if you have an immediate financial need, taking money out of your 401k plan is always far better than potentially putting it on a credit card where you're going to pay an exorbitant amount of interest, or going to, say, a payday loan company where they are going to absolutely kill you with the interest rates that they charge for that. So in both instances, borrowing against your own money, in my opinion, is far better than borrowing against from an outside lender with potentially egregious interest rates, or potentially just losing out on retirement savings. Now, loans do have drawbacks, right? You do have to pay yourself back. You have to pay yourself back with interest. And because of that, as I mentioned before, it's difficult for a lot of people to pay off the loan and continue to defer into the plan. Now, if you stop your deferrals, you also don't get any match, and the company does not match on loan repayments. So if you have a loan and you stop contributing, essentially you are paying yourself back with interest, but you're not deferring any new money into the plan, and you're also missing out on the match that Selden provides to you. So that is some drawbacks. Also, if you do take a loan out of your 401k plan, if you are a younger participant and you are a very aggressive participant, the other drawback from taking a loan is that while you are going to pay yourself back with interest, that money is physically removed from your account. So that $15,000 in the same scenario on the screen right now draws your account balance down to $23,000. Say we have a year like 2023 when the market was up 32%. You're not going to gain 32%. That $15,000 is out of the market. The only thing you're going to earn is about, say, 4% interest over the course of the loan payments. So if you're younger, being out of the market has a much bigger impact because you should be aggressive. You want to gain as much money as possible when the market's up. Whereas for participants who are older, I just turned 50. I can actually somewhat start to see retirement horizon in my future. And I personally, and I'm just using myself as a personal example, everybody's gonna be a little bit different, right? But I have a decent amount of money off to the side that I don't want to take any risk on investing it in the market, because if the market loses 50% like it did in 07, 08, I don't want to risk that money. So because I already had that money sitting off to the side in a money market account, I wasn't worried about that money being pulled out of the market or losing out on any appreciation. I personally did take a loan out of my 401k plan a few years ago. Here in Texas, we are prone to natural disasters, just like you guys in Nebraska are really all over the U.S. And because I knew I wasn't going to move that money back into the market ever, I actually was able to make more on my money paying myself back with the loan with interest than I would have made sitting in a money market account. And the reason I took the loan out in an amount that's very similar to what is on this example, which is why I liked it, is to buy a backup generator for my house. We lose power due to storms here all the time. I know you guys with the tornadoes, and not just those in Texas and in Nebraska, but all over the U.S. With the weather is always changing, a lot of people lose power pretty quickly. And after mini floods and hurricanes, we made the decision to use that money for a backup generator. So that for us was a very feasible decision. Also, for people who are older, if you have money sitting off in your 401k plan off to the side that you don't want to risk any market losses on, and you have a decent amount of time, say 5 years or more until you're going to retire, then a loan could also be a very smart option for you. Other times where I think a loan is beneficial, if you have credit card debt. And I also like to use real life examples, and I have no qualms about sharing this with people. When I was in my 20s, I got into some trouble with credit card debt, missed one payment by 3 days, and my interest rate jumped up to 29%. I could not pay that back. And so, under that scenario, I didn't take a loan out of my 401k, but I did like a credit refinancing type deal where I had to pay my loan back, my credit card debt back with interest, couldn't use my credit cards at all. For those of you who are in a scenario like that, I would say first and foremost, if you do have the ability to utilize an outside agency, it's not a default. It's not going against or not paying your credit. There's agencies out there that you can work with. They will work with the credit card company. They agree to pay back the loan or your whatever is your credit card balance at a fixed rate over the course of 5 years, with the caveat you don't have access to any credit card for that 5 year period. I did that, bit the bullet, didn't hurt my credit score. Wasn't easy, but it was a growing lesson into adulthood on how to properly manage my finances. So for those of you, and I know a lot of people have that issue, they kind of get in over their head when it comes to credit card debt. We're all human. It happens. You're not the only person, trust me. No shame in that. So if that is kind of a scenario that you're looking at, think about other options that are out there. If that is not available to you and you are, say, a credit refinance as opposed to a default or a bankruptcy, if that's not an option available to you and you are paying a very high interest rate, take out just enough of a loan to pay off that credit card balance. Try not to use the credit cards anymore because, again, you're going to be paying back the loan out of your own paycheck. So that's going to draw down the amount of money that you have to spend. Also, if you have not just credit card debt, but if there's really any egregious expenses that you need to take money out for, it could be a down payment for a house. In that case, if it helps bring down your, I'm trying to think of the word, the initial is PPI, there was a term for it. If you don't have 20% down payment, you pay an additional rate. I also think it can be beneficial for people to take a loan out if they're using it for a down payment on their house. When it's not optimal or smart or efficient to take out a loan, so you want to buy a new car. And unfortunately, that's just one area where I think we should all live within our means. That's just my own personal impression or opinion. Also, if you just want to go take a vacation, again, 401k plan is a long-term retirement savings account. It's not really meant as a withdrawal vehicle, just taking money out when you need it. So for everyday expenses, a loan's probably not going to be beneficial. But there are scenarios. There's far more scenarios that I could probably list in 1 hour on when it is appropriate to take the loan out. But for the most part, if it is an immediate financial need, say paying off or even student loans, I know people who have used loans from 401k plans to pay off student loans. I was fortunate not to have student loans. I going to college in the 90s in Louisiana public school, tuition was quite inexpensive compared to what it is these days. And I know that with loan or student loan debt, the way that it's structured can make it very difficult for people to pay those debts off. So that's another scenario where I'm also a huge proponent, where I think it's better if you have the ability to take a loan out to pay off any student loan debt. It's far better by missing out on the market returns by doing that, as opposed to paying, again, exorbitant rates to private companies that have financed that student loan debt, which could take, in some cases, 10, 15, 20 years for a lot of people to pay down. So those are questions that really you have to ask yourself. What is the need? How is this going to impact me? But just keep in mind that one of the reasons why a lot of people are tepid when it comes to contributing to their 401k plan, and one of the biggest issues that I hear time after time is participants saying, well, I would like to contribute. I know I need to contribute, but it worries me that my money is going to be locked up, that I can't have access to it. That's not the case. You do have access to your money in the form of either hardship or loan. But again, everybody is going to have a slightly different, unique situation than the other. Also on this page, and I'm going to turn it over to questions after that, is it a good idea to borrow from your 401k? So using a 401k loan for elective expenses like entertainment or gifts isn't a healthy habit. In most cases, it'd be better to leave your retirement savings fully invested and find other sources of cash. On the flip side of what's been discussed so far, borrowing from your 401k might be beneficial long-term and could even benefit your overall finances. For example, using 401k loan to pay off high interest debt like credit cards could reduce the amount you pay in interest to the lenders. As I mentioned this before, what's more, 401k loans don't require a credit check and they don't show up on your debt as debt on your credit report. Another potential positive way to use 401k loans is to fund major home improvement projects that raise the value of your property enough to offset the fact that you're paying the loan back with after-tax money, as well as any foregone retirement savings. If you do decide a 401k loan is right for you, here are some helpful tips. And then under the scenario, I'm sorry, I don't know why that was blocked out there, but it might be tempting to reduce or pause your contributions while you're paying off your loan, which I mentioned before. If you're doing your regular contributions, under this scenario, again, long-term impacts for somebody a loan versus a hardship and why it's beneficial. As I mentioned before, hardships cannot be paid back, but loans are. So under the same scenario, somebody took out with a $38,000 account balance, they're age 45. If they took out a loan, they still paid themselves back at the age of 67. They had right at $430,000. But that same $15,000 taken out as a hardship that can't be repaid leaves a gap of almost $67,000. So unfortunately, that's one of those scenarios where that $15,000 turned into a $67,000 missed earnings that you're going to miss out on. Again, in some cases, you may not have the ability to pay back the loan, and a hardship truly should be there only in what I would say would be an egregious, immediately huge financial need. If a tree falls through your house and insurance isn't going to cover it, or for whatever reason, or you just have a massive structural damage from a tornado, or it could be a variety of sources. If you just need the money and you know you can't pay it back, know that the withdrawal is a potential option. I would still do a 401k withdrawal if it were me, as opposed to going to outside lending companies that were going to have a really high interest rate, or even putting it on your credit card. Again, those are good in an emergency, but the amount of interest you're going to pay back in time the amount of time it's going to take to pay that interest back could be very detrimental also to your long-term savings. So keep these items in mind. Both of them have pros, both of them have cons. Definitely the loan has more pros to it as opposed to cons than the withdrawal. But in both cases, you're still going to be withdrawn from the market, losing some appreciation. But again, loans much more beneficial than a hardship if you can manage to get by with that.
Hey, Kurt.
Yes, ma'am.
We did have a question on what qualifies for that hardship withdrawal or hardship distribution.
So it's going to be an immediate financial need for damage to a primary home, risk of eviction, medical expenses. Trying to think, those are the top ones. I'd have to go and, now that you put me on the spot, I'll have to go and look that up. It's immediate medical expenses, eviction from primary residence, whether it be a mortgage that you need to catch up on, or you're in threat of being evicted from a rental property. Medical expenses, those are the big three. There's another one, but I'm drawing a blank on what that is. But it's usually going to be primary residence or eviction or medical expenses.
Okay, perfect.
Yeah.
They're also asking, does credit card debt qualify?
As
A reason to
for
take the
hardship?
hardship, yeah.
No. So that is also something a little bit different. When it comes to a hardship, you have to qualify for it. As I
Mhm.
mentioned, immediate financial need, mainly going to be eviction or foreclosure of your primary residence, medical expenses, and or your home has been hit with a natural disaster. So those are the big three. You do have to qualify for that. It is on what's called self-certification. So it's basically on the honor system now. If you are audited by the IRS, you have to have proof that you did qualify for that hardship. But for a hardship, there are qualifying reasons that you have to meet. Whereas for a 401k loan, you can take that out for any purpose.
Perfect, thank you.
You're very welcome. And so essentially, whether it be a financial hardship and or a loan, you would still go to Fidelity on their website, or you can call up their investor center and you can talk to them, and they'll be able to take either the loan out for you, and they'll give you the modeling for the amortization rate. If that's the case, you do go ahead with the loan. Then Fidelity will provide Selden with that amortization schedule, and then you'll be set up to pay that loan off for the length of time that you select. One of the problems and drawbacks, though, when it comes to loans, because it is required to be paid back, if you were to leave employment with Selden, you really only have two options. One, you can pay the loan, you have to pay off the remaining balance within 90 days. Otherwise, the loan goes into default. So if you do have a large loan that's outstanding, say you take out $30,000 today, you leave at the end of the year, you go to another company, you still have, say hypothetically, $28,000 in loans outstanding. You have to write a check for $28,000 to pay that loan off. If not, it goes into default. And then it'll be a distributable event where it's basically like a withdrawal was. You'll pay taxes and you'll pay penalty on it. Or you can negotiate with Fidelity and they will allow you to pay back via ACH payments for the rest of the life of that loan. So a couple downsides. If you are thinking about leaving the organization, loan's probably also not going to be beneficial because again, if you don't have the ability to pay it back within 90 days of termination of service, then it is a distributable event subject to tax and penalty. And so some of these are, and I will say some of these I might be of alternatives. They may be beneficial, some aren't. Now, one that we do see a lot of people doing is using, and I don't know because I don't know your health and benefit side. If you have HSAs, what's good about an HSA if you have a high deductible medical plan is that you're not required to take the money out, even if you have qualified medical expenses. You can allow that money to just accumulate. It goes in pre-tax. You actually have double taxation benefit for HSAs. The money goes in pre-tax, just like you do with your 401k deferrals. But also when you take the money out, it's very much like a Roth IRA. You're not going to pay any taxes on it either. So you get pre-tax deferral plus after tax, no tax payment when you spend it. And so that can theoretically accrue for many years. Some people are using that almost as a retirement savings tool on its own. They max out their HSA, they don't touch it, with the idea that whenever they are reaching retirement age, it can be used for a plethora of different expenses, even people that go into like a assisted living facility. We've seen people save up their HSAs for years to use it for something along those lines. Also, tap into emergency savings. Great if you have it, but realistically, as I said before, we live in the real world. Not everybody has $1,000 on hand. I think only 30% of Americans have $1,000 liquid cash ready to spend in an emergency. And also when it comes to emergencies, wouldn't it be nice if they were only $1,000? Most are far higher than that. So if you think about it, could you tap into emergency savings if you have a $10,000 emergency? Most people, I'd say the majority of Americans don't. If you have the ability, transferring high interest credit cards to a new credit card with a lower or zero interest, that can also be beneficial. And this is not meant to be financial advice for anybody out there. But I do know that a lot of people, because I did this also when I was younger, as a way to get rid of some high interest credit card debt. Problem is you really need to pay those off within a certain amount of time to get that beneficial interest rate. Also, a home equity line of credit or a personal loan, those aren't horrible in my opinion. If you can get one from the bank, far better than a payday loan or credit card debt, but one that I would personally try to avoid. And then if you are an older person over the age of 59 and a half and you have money in a Roth IRA that can be taken out tax-free, penalty-free, also an option for you out there, but not an option if you're under 59 and a half. So, well, I actually kept that right at 30 minutes as I had promised. So with that, I am going to stop sharing my screen. Okay. Well, why is it not letting me? Well,
We
okay.
did have a comment kind of circling back to those hardship withdrawals as well. Someone had asked about the ability, are those funds that you could use to purchase a home, for that down payment? They also mentioned wondering about college tuition, if it's eligible for hardship withdrawal.
So for hardships, it is what the IRS determines is immediate and heavy financial need that cannot be met by other sources. They are medical expenses, home repairs, preventing foreclosure or eviction, funeral costs, and tuition. The last two are the two that I was drawing a complete blank on. So tuition is available for both you and or your dependents.
Wonderful.
Yeah, I always forget about the funeral cost.
Great information. Great questions, guys. Keep those coming. Does anybody have any other questions for Kurt? We've got a little bit of time left.
Yeah, and another one that and it was kind of alluded to in that document that I'll email out after this call. I have known people in the past that if they are thinking about selling their house, they'll take out a loan from their 401k to do some, I call it cosmetic updates. To have a house, the interior painted is thousands of dollars to hire somebody to do that. So I've known people who have taken out money from their 401k plan, use it to have like professional cosmetic services done to their house, which increases the value above and beyond what that 401k loan was for. And then once they sold their house, they used the earnings to pay that loan back. So as I mentioned before, a couple just like housekeeping items. Loans can be from 1 to 5 years. You get to pick the payment schedule, and you also have the ability to pay the loan back sooner if you have the ability to do that. So under that scenario, if somebody's using the money to make updates to their house, they take out a 5-year loan, because with the housing market, it may sell in a day. It could take a year. It really, no one house sells in the exact same time frame as another one. So if you want to do something along those lines, take it out for a year, maybe 2 years, 3. That would lower the amount that you're required to pay back. Takes a little bit of stress out from you. And then once the house is sold, under that scenario, and you can just turn around, take the proceeds, pay that loan off, and then you're over with.
Awesome. Yeah, I could see where borrowing that money in order to make a home improvement, so you're making that much more on the proceeds of your home. I could see where that would be beneficial. It's just really about making sure the juice is worth the squeeze at that point.
Absolutely. Yeah, and $20,000 in improvements to a home can, depending upon the area, increase the value by $50,000. So if you take out 20, you earn an extra 30. That's a very wise decision. And again, it still far beats putting it on a credit card. And I say that emphatically as somebody who, 20 years ago got themselves in trouble with credit card debt. It makes me a little nervous knowing that people are building up credit card balances post-COVID. So, I would say, if at all possible, use your own money in situations like we've discussed, taking out the loan and our hardship, as opposed to credit card debt, which in many cases could haunt you for far longer than 5 years that a loan would be paid back to.
We've got one other question, and I think you hit on this a little bit about as far as separation from Selden, but what are the potential risks and the long-term impacts of borrowing from the 401k? And how does that affect the retirement savings and taxes if they leave their job before it's repaid?
Yeah. So it would be just like whatever the remaining balance of the loan is. So you took out $30,000 over 4 years. 2 years later, 2 years passes, you leave the company. I'm just going to use simple math. Took out $30,000. 2 years you leave, $15,000 is left on the loan payment. If you don't pay that loan back, you have 90 days. And once Selden on payroll notifies Fidelity that you are terminated from service, that starts the 90-day clock. You'll receive information from Fidelity. Most people probably will consider it to be garbage, may not even open it, which is also a risk. Or if it comes electronically, you may think it's spam, which is very expected these days. Under that scenario, though, that $15,000, you have 90 days to pay it back. If you don't pay it back, that $15,000, if you're under 59 and a half, is subject to a 10% premature distribution penalty. On top of, you have to claim that $15,000 as income for the year in which the loan was deemed defaulted in. So say you left in February, the loan defaulted in June of this year, that $15,000 will be claimed as income for tax year 2025. You would receive a 1099-R from Fidelity. And so that's going to increase your taxable wage base on top of being subject to a 10% penalty. And then that money from a hardship cannot be paid back. It will always be out of your retirement savings for perpetuity, unlike a loan, which you do pay back if you're still employed.
Okay, perfect. Any other questions?
Well, I hope that's because I did such a good job explaining it.
I know. I was gonna say that was a lot of information, but very,
Yeah.
very good information. So, and you
Yeah. And
always
like I
break it
said,
down so easy to understand.
yeah, and I will forward that document out. One of the reasons why, because it's Fidelity, you guys are with Fidelity. We
Mhm.
personally don't have a compliance approved material specifically for loans. So Fidelity had one, and their talking points is exactly the same talking points I've been using with participants for going on 28 years now in the 401k industry. At least it's nice to know that Fidelity is in agreement, or I'm in agreement with Fidelity, however you want to look at it, kind of from a universal standpoint. And oftentimes it kind of bugs me a little bit. You hear so many people say, never take a loan out of your 401k. That is bad information, in my opinion. You're contributing to the plan. We all have emergencies. Obviously, taking a loan out shouldn't just be the first line, and it shouldn't just be a recurring thing. But in a real emergency or in an event, and again, I use my own example. If you do have a lot of money sitting out on the side, if you're worried that the market is going to be losing money, also one thing, I don't want anybody to take this as, hey, this is a reason to take a loan out. But if you think about years like, say, 2022, when the stock market was down 33%, if you had a loan out, that money that was up for a loan didn't lose any value. You're actually earning some appreciation. So not to say I want anybody to try to time the market, but if you are a very conservative investor, if you have money sitting in, I believe it's the managed income portfolios offered within your plan, has a crediting rate of about maybe 2% on an annual basis, and you need to borrow some money, that might be a situation where you're going to pay yourself back more in interest than what you would earn in that money market fund. So that is another, I would say, prime example of when it really makes sense to use your 401k to take out a loan if you're not really earning much appreciation. It's just you won't lose money if the market goes down, but you won't earn anything but prime plus one on the remaining loan balance. But at least you're still paying yourself back interest as opposed to an outside third party.